Bismillah Rahman Rahim. This is the fifth video on cost, volume, profit. In this video and the next two videos, we will talk about the additional issues on cost, volume, profit. In this video, we will describe the essential features of a cost, volume, profit income statement. We will apply basic cost, volume, profit concepts, and finally, we will solve the exercises comprehensively. In the sixth video, we will explain the term sales mix and its effects on break-even sales. In the seventh video, we will explain how to determine sales mix when a company has limited resources, and finally, how operating leverage affects profitability. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope this video help students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope this video helps ACCA, AICPA, CPA and CMA aspirants. We also hope that this video help fresh graduates who have joined the companies and want to refresh their learning on the essential features of a cost, volume, profit, income statement and apply basic cost, volume, profit concepts. Let us start with the essential features of cost, volume, profit, income statement. Cost, volume, profit analysis looks at the impact that varying levels of cost and volume have on operating profit. It is a way to find out how changes in variable and fixed cost affect a firm's profit. Companies can use cost, volume, profit to see how many units they need to sell to break even or cover all the cost or reach a certain minimum profit margin. Cost, volume, profit analysis makes several assumptions, including that the sales price, fixed and variable cost per unit are constant. Let us look into cost, volume, profit, income statement. A cost, volume, profit, income statement is for internal use only. All costs and expenses are classified as variable and fixed. It reports contribution margin as a total amount and on a per unit basis. Let us look into an exercise. And Garner Incorporation sold 20,000 units and recorded sales of 800,000 for the first quarter of 2014. In making the sales, the company incurred the following cost and expenses. We have the variable cost and we have the fixed expenses. So we have to prepare a cost, volume, profit, income statement. So we start with the sales and the sales is 800,000. Then we have the variable expenses 250,000, 100 and 82. So the total variable expenses are 432,000, and sales minus variable expenses will give us the contribution margin of 368,000. Then we have the fixed expenses 110,000, 25 and 73. So the total fixed expenses are 208,000 and the net income will be 160,000. Next, we have to compute the contribution margin per unit, and the total contribution is 368, and the total number of units sold is 20,000. So this is 18.40 per unit. Next, they asked to compute the contribution margin ratio, and again we have that contribution margin, that is 368 divided by the total sales, and that is 800,000, and this is equal to 46%. Or we can have the contribution margin per unit 18.4, and the selling price per unit, that will be 800 divided by 20,000, that is 40. So again we have 46%. Next, let us talk about how to calculate break-even point. But before that, I can tell you that I have put the same exercise in an Excel sheet in case you find my writing difficult to read. So next, let us talk about how to calculate break-even point in units when fixed cost and contribution margin per unit is given. We will calculate break-even point in dollars when fixed cost and contribution margin is given, and we will also calculate the required sales in units to achieve a target net income and required sales in dollars to achieve target net income. So we have the fixed cost from the slide number 5, then the total fixed cost is 200,000. So we have fixed cost as 200,000, and the contribution margin is given to us as 200, selling price minus variable cost, that is 200. So the break even point in units is 1000 units. Then they ask us to calculate the break even point in units. We have the contribution margin per unit. Then they ask to calculate the break even point in dollars, and for this again we have the fixed cost, that is 200,000, and now we will be using the contribution margin ratio, and the contribution margin ratio is 0.4, so that makes us 500,000. Then they asked to calculate the sales in units to earn a targeted net income of 250,000. So we have the fixed cost of 200,000 plus the target net income 250,000 divided by contribution margin per unit, that is 200. So we need to sell 2,250 units to make a profit of 250,000. And if we want to make a sales earn 250,000, so once again 200,000 plus 250,000 divided by contribution margin ratio, and that is 0.4. So this will be $1,125,000. Okay, so This is sales in dollars and this is sales in units to earn the required expected profit. Next, let us talk about the margin of safety, and I have put again this calculation over here in case you find difficult to read my handwriting. So next we talk about the margin of safety. Uh, so margin of safety tells us how far sales can drop before the company will operate at a loss, and it can be expressed in dollars or as a ratio as well. So we have the sales of 800,000 and the break even is 500,000. So the margin of safety in dollars is 300,000, and the margin, if you want to calculate the margin of safety ratio, so we have the margin of safety in dollars, that is 300,000 divided by the expected sales or actual sales, that is 800, so that is 37.5%. So as can be seen that the sales could drop by 300,000 or 37.5% before the company would operate at a loss. Now, any business is influenced by business environment. A company has to make necessary changes whenever there is a change in the environment, like a competitor may give discount on sales or changes the production plans, or the supplier increases the price of raw material supplied to the company. So let us look into these three different situations that may affect a company. Now we will be using the same in the following information. There is a unit selling price, we have the unit variable cost, we have the fixed cost, and the break even is in units is 1000 units and in dollars it is 500,000. So let us look into the first case. And a competitor is offering a 10% discount on the selling price of its camcorders. Management must decide whether to offer a similar discount. So what effect will a 10% discount on selling price will have? And we have 500, that means the selling price. So 10, if we reduce it by 10, a discount of 10% means we have to reduce the price by 50. So the selling price will be 450. So fixed cost will remain the same, that is fixed 200,000, and the contribution margin per unit now will be sales minus variable cost, and that is going to be 150. So the break even sales will be 1333 units. So for the company, the change of 10% discount requires a monthly sales to increase by 333 units in order to make a break even. Let us look into the second case. The management invest in new robotic equipment that will lower the amount of direct labor required to make camcorders. So the direct labor is going to decrease. Estimates are that total fixed cost will increase by 30%. So we have a increase of 60,000, 30% of 200,000, and that variable cost will decrease by 30%. So there will be a decrease in the variable cost by 90, that is 30% of 300. So we have a new variable cost of 200. So what effect will the new equipment have on the sales volume required to break even? So there is no change in the fixed cost. The fixed cost changes to 260,000, and the contribution margin will be sales minus variable cost. It is 500 minus 210. That will give us 290, and when we divide, we get 897 units. So the break even is going to reduce by 103 units if there is a case number 2, that is an increase in the fixed cost by 30% and increase in variable cost by 30%. Let us look into the third situation, and here Virgos, that is the company's principal supplier of raw material, has just announced a price increase. The higher cost is expected to increase the variable cost of camcorder by 25. That means now our variable cost will be 325. Management decided to hold the line on the selling price of the camcorders. It plans a cost-cutting program that will save 17,500 in fixed cost per month. That means the fixed cost will decrease by 17,500, and this will be equal to 182,500. So Virgo is currently realizing monthly net income of 80,000 on sale of 1400 camcorders. What increase in units sold will be needed to maintain the same level of net income? So the variable cost is going to increase, and that is 300 plus 25, that is 325. The fixed cost will be reduced by 17,500. So 200,000 minus 17,500, that will give us 182,500. So the contribution margin now will be sales 500 minus variable cost 325, that is 175. So the fixed cost is going to be 182,500 plus 80,000, the net income we want, 80,000 divided by contribution margin per unit, and we have just now calculated this as 175. So we need to a sale of 1500 units to maintain the same level of net income. So increase in units, so we have to increase 1500 minus 1400, we have to increase our sales by 100 units in this case. Next, let us do some exercises, and the first one is on computing the break-even point. So Westland Corporation has a total variable cost of 175,000. The total fixed cost is 120 and total revenue is 250. Compute the required sales in dollars to break even. So we have to first calculate the contribution margin ratio, and that is contribution margin divided by sales. So we have the contribution margin of sales minus variable cost 250 minus 175, that will be equal to 75, and divided by the total sales, that is 250,000. So this is equal to 30%. So the contribution margin ratio is 30%. So we want to calculate the required sales in dollars. So we have the fixed cost, required sales in dollars. This is equal to fixed cost divided by the contribution margin ratio. So fixed cost is 120,000 divided by 30%, and that is equal to 400,000. So next, let us solve an exercise on determining sales for target net income. For Ortega Company, variable costs are 60% of sales and fixed costs are 210,000. So we have the variable cost, that is 60% of sales, and fixed costs are 210. Management's net income goal is 60,000. So we need to compute the required sales to achieve management's target net income of 60,000. So we do not know the sales in this case, so let us assume that our sales is equal to x dollars. So sales is equal to variable cost, that is 60% of sales, plus fixed cost, that is 210,000, plus the target net income, that is 60,000. So if we solve, so this will be 0.4x is equal to 270,000. So x is equal to 675,000. So the company need to have a sales of 675,000 to have a target net income of 60,000. Next, let us solve an exercise on the margin of safety and the margin of safety ratio. For Costco Company, actual sales are 1,200,000 and break even is 960. Compute the margin of safety in dollars. So we know the margin of safety is sales minus variable cost, 1,200,000 minus the break even, that is 960,000, that is equal to 240,000. And for margin of safety ratio, we have margin of safety divided by the sales. So margin of safety is 240,000 divided by sales, it is 1,200,000. So that is equal to 20%. So the margin of safety is 240,000 and margin of safety ratio is 20%. Let us compute break-even point and margin of safety again. And here we have the Bonita Inn is trying to determine its break-even point. The inn has 75 rooms that are rented at 60 a night. These are the operating costs. We have so we have the fixed cost. These are the fixed costs over here, and these are the variable cost. We determine the inn's break-even point in number of rented rooms per month and dollars. So we have to calculate both in units as well as in dollars. So first we calculate the contribution margin per room, that is sales 60 minus variable cost, that is 8 plus 37. So this will be equal to 15, and the contribution margin ratio will be 15 contribution margin divided by the selling price per unit, that is 60. So that gives us 25%. So we have calculated the contribution margin and the contribution margin ratio, and then they say, and we have the fixed cost 8,800, 2,400, 1,500 and 800. So this is equal to 13,500. So break even point in rooms that is units. So this will be fixed cost 13,500 divided by the contribution margin, and the contribution margin is 15. So this will be equal to 900. So this is part 1, and then we have to calculate in dollars. So we have the break even point in dollars, and this is equal to uh, the number of rooms, that is 900 times then 60. So that is equal to 54,000 per month. So they have to generate revenue of 54,000 to have a break even. We move on to the part B. If the in place plans on renting an average of 50 rooms per day, assuming a 30-day month. So what is the monthly margin of safety in dollars and the margin of safety ratio? So we have the expected sales, revenue, and we have 1500, sorry, we have the planned activity, and the plant activity is 50 rooms times, we want it for 30 days, so that is equal to 1500 rooms per month, and the expected revenue will be 1500 times 60, that is equal to 90,000. Now the margin of safety in dollars will be 90,000, the expected revenue, minus the break even in dollars, that is 54. So the margin of safety is $36,000. Then they asked to calculate the margin of safety ratio. So margin of safety ratio, this will be equal to margin of safety in dollars, that is 36,000, divided by the expected sales of 90,000. So that is equal to 40%. Next, let us compute margin, contribution margin, break even point, and margin of safety. Now, in the month of June, Joe's Herbert Beauty Salon gave 4,000 haircuts, shampoos, and permanents at an average price of 30. So the selling price is 30 per unit. They have a fixed cost of 16,800 and variable cost of 75. Variable cost is 75% of sales. So we have to calculate the contribution margin in dollars per unit and as a ratio. So we have part A first of all. So contribution margin in dollars. So we have the sales, and sales is 4,000 times 30, that makes 120,000. Then we have the variable cost, and the variable cost is 75% of sales. So 120,000 is our sales and it's 75%, that is equal to 90,000. So we have the contribution margin, and contribution margin will be 30,000. Next, they ask us to calculate the contribution margin per unit. Contribution margin per unit. So this will be equal to selling price, that was 30, minus variable cost, and variable cost is 75% of 30,000 of 30, sorry. So that is 30 minus 22.5, that gives us 7.5. Then they ask us to calculate the contribution margin ratio. So contribution margin ratio is the contribution margin per unit, 7.5, divided by sales, and the selling price is 30, so that is equal to 25%. Then we move on to part B, and they say using the contribution margin technique, compute the break-even point in dollars and units. But we have to use the contribution margin technique, that is for part B. So we have break-even point in dollars, that is fixed cost 16,800, divided by the contribution margin ratio, and that is 25%. So break even point in dollars will be 67,200. Then we have the break even point in units, and this will be again fixed cost 16,800 divided by contribution margin per unit, that was 7.5. So this is equal to 2,240 units. This is in dollars. Then we go to part C. They say compute the margin of safety in dollars and as a ratio. Now margin of safety in dollars will be sales. Sales was 120,000 minus the break even point in dollars, that was 67,200. This is equal to 52,800. So this is the margin of safety in dollars, and we have to calculate margin of safety ratio. So we have the margin of safety in dollars 52,800 divided by 120,000, the total sales. So this is equal to 52,800. Sorry, this is equal to 44%. Next, let us compute net income under different alternatives. Okay. Now, Norton Company reports the following operating results. For the month of August, we have sales of 310,000 units. Units are 5,000, sorry, this is the sales in dollars, and they are selling 5,000 units. Variable cost is 210 and fixed cost is 75. Management is considering the following independent courses of action to increase the net income. Now increase selling price by 10% with no change in total variable cost or sales. So first of all, let us calculate the current selling price, and the current selling price is 310,000 and the number of units sold is 5,000. So the current selling price is 62. Now we go to the case number 1, and in case number 1 they say increase selling price by 10%. That means we have presently the selling price of 60 plus 10% of 62. This will be 62 plus 6.2, that is 68.2. So the net income will be now 68.2 times the number of units sold, that was 5,000. 68.2 times 5,000 minus the variable cost, it do not change, that remains the same, 210,000, and minus the fixed cost, that is 75,000. So this is equal to 56,000. Okay, then we go to number 2. Reduce the variable cost to 58% of sales. So the variable cost is going to reduce by 58% of sales. So now we calculate the net income. The sales will be how much? The sales will be 58% of sales, and the sales was given to us as $310,000. So we have sales of 310,000 and the fixed cost do not change, but the variable cost is 58% of 310,000. So this will be 310,000 minus 75,000 minus 179,800. So this is equal to 55,200. We go to number C now. Number 3, they reduce the fixed cost by 20,000. So if they reduce the fixed cost by 20,000, that means the fixed cost now will be 75,000 minus 20,000, that is 55,000, and the net income will be the sales 310,000 minus the variable cost 210 minus fixed cost 55, so that is equal to 45,000. So compute the net income to be earned under each alternative. So the net income is 56 here. Here the net income is 55, and in the third case it is 45. Which course of action will produce the highest net income? And obviously you can see that it is the number 1 that is going to generate the highest net income. Next, let us compute break-even point and prepare a cost, volume, profit, income statement. So Comfy Airways Incorporation, a small 2-plane passenger airline, has asked for your assistance in some basic analysis of its operations. Both planes seats at 10 passengers each, and they fly commuters from Comfy Base Airport to the major cities in the state metropolis. Each month 40 rounds trip flights are made. Shown below is a recent month's activity in the form of a cost, volume, profit, income statement. So we have the revenue, we have the total variable cost, contribution cost, margin, we have the fixed cost and the net income. So first of all, calculate the break even point in dollars and number of fares. So again we start with the contribution margin ratio, and the contribution margin ratio will be the contribution margin, that is 30,000, divided by the sales, that is 48,000. So this is equal to 62.5%. Next, we calculate the break even point in dollars. So that is fixed cost, and the fixed cost is 20,250 divided by the contribution margin ratio, that is 62.5%, that is 32,400. So break even point in dollars is 32,400. Then calculate the break even point in dollars, and the second they ask for the number of fares as well. So first of all, we have the round trip of we have 48,000. This is the sales revenue, and the fare is 400, so we had divided by 4, that gives us $120. So the break even point in fares, or as you can say in units, will be the fixed break even point in dollars, 32,400 divided by 120, that is 270 fares. So to break even, they must have at least 270 fares. Okay, then without calculations, determine the contribution margin at the break even point, and we know that at the break even point the fixed cost and the contribution margin are equal. Therefore, the contribution margin at the break even point would be 20,250, the fixed cost. Okay. Next, if the fares were decreased by 10%, an additional 100 fares could be generated. However, total variable cost would increase by 20%. So first of all, let us look into part C. So first of all, look into the fares revenue. Now the fares revenue will be 120, we have already calculated, and this will reduce by 10%, so minus 12, that is equal to 108. So the total fares revenue will be 108 times, you see the number is increasing by 100, so 400 plus 100 is 500. So this is equal to 54,000. Next we have the variable cost. And the variable cost, they say that the variable cost would increase by 20%. So we have a variable cost right now, and the variable cost is 18,000, and this is going to increase by 20. That means times 1.2. So the variable cost is 21,600, and sales minus variable cost will give us the contribution margin of 32,400, and the fixed cost is 20,250. So the net income is 12,150. So we have complete. Should the fare decrease be adopted, and we can look into it and answer accordingly. Yes, the fare decrease should be implemented because our net income is increasing by 12,150. Next, let us prepare a cost, volume, profit, income statement before and after changes in business environment. Now, Hall Company has sales in 2014 of 1,560,000 on 60,000 units. Variable cost totaled 720,000 and fixed cost totaled 500,000. A new material is available that will decrease the variable cost per unit by 25% or $3. However, to process the new material, fixed operating cost will increase by 150,000. Management feels that one half of the decline in the variable cost per unit, one half of the decline, should be passed on to customers in the form of sales price reduction. So the sales price will be reduced by this amount. The marketing department expects that this sales price reduction will result in a 5% increase in the number of units sold. So prepare a projected cost, volume, profit, income statement for the year 2014. So we have the sales, and the sales is for 60,000 units, and the total is 1,560,000. So you divide, so times, that will be 26 per unit. The variable cost again will be for 60,000 units, and the variable cost is 720,000. So per unit this will be 12, that makes 12 over here, and the contribution margin is sales minus variable cost, that will give us 840,000, and the per unit it is going to be 14. The fixed cost is given as 500. So we will subtract the fixed cost and we get the net income of 340,000. So we have prepared the cost, volume, income statement, assuming the changes have not been made. So that is the past one. We have not made any changes, and in part B we are going to adopt the changes that are there in the prices, etc. So we are not reducing the units, that is 60,000. And let us start. First of all, a new material is available that will decrease the variable cost per unit by 25% or 3% or $3. So we have a variable cost of 12. The number of units is 60,000 times 12 minus 3, that gives us 9. So sorry, um, we have the sales of 60,000 and sorry, I'm very sorry. We have the variable cost of the variable cost per unit will decrease by $3. So that means the variable cost per unit now is 12 minus 3, that is 9. The fixed operating cost will increase by 150,000. So we have the fixed cost of 500. It will increase by 150,000, that makes 650,000. Management feel that one half of the decline in the variable cost per unit should be passed on to the customers in the form of a sales price reduction. So one half means half of 3, that is 1.5. So the selling price will reduce now. Before, the selling price was 26 and this will be reduced by 1.5, so that is equal to 24.5 times 60,000. The sales is not changing, that is 1,543,500, and the per unit it is going to be 24.5. The variable cost is 9. The marketing department expects that this sales price reduction will result in a 5% increase in the number of units sold. So 5% will be 1 minute. Check. 60,000 and 5%, 0.05 times 60, 0.05 times 60,000, that is, so the sales will increase by 5%, that is, this will be 63,000, and the variable cost is 9, and 9 times 63,000, this will be 567,000. So the contribution margin will be 976,500, and this will be 0.5, 15.5, and the net income will be 326,500. So I have put this calculation, but this has to be not 60,000, this will be 63,000. Rest of the numbers are correct. So, and this will be 24.5 and this will be 15.5. Okay. So this completes our discussion on features of a cost volume profit income statement and basic cost volume profit concepts. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much and happy learning.